Welcome back to Mortgage Markets and More. I'm your host, Peter DeAngelo from Rate. I hope you're doing well. I don't have good news today, unfortunately. Yes, interest rates have gone up quite a bit, and we're going to just take a look at that and some of the reason why before we move on to some more of a deep dive into what's going on in the economy and try to make sense of something that seems to be nonsensical right now. Let's start off with our review of mortgage rates as of the recording of this podcast the Thursday morning before its release, and these are according to Mortgage News Daily. 30-year fixed-rate mortgage averaging 6.99%. The 15-year fixed-rate mortgage is averaging 6.34%. 30-year jumbo, 7.1%. 30-year FHA, 6.44%. And the 7/6 SOFR adjustable rate mortgage, 6.63%. Rates have moved up across the board. And a large part of the reason why continues to be the same thing that we talk about every week. That situation has not changed. We're talking about tariffs, headlines. We're going to go into the details of that. But high level, it's a lot of the chaos and the uncertainty about the economic outlook. Now, looking at the bond market, this is giving us a glimpse as to where people's heads are at with where they think interest rates are going to go. So I like to just reiterate, we look at the interest rates as they are right now, and then the bond market gives us a glimpse of what we can expect, because this shows us the mentality of the investor and what they believe is going to be monetary policy moving forward and expectations for the market. So here are the bond yields as of this morning. 10-year Treasury yield is at 4.507%. The 5-year is at 4.135%, and the 2-year is at 4.028%. We're back in an environment that was comparable to prior to the new year. This is what the bond market looked like as we were wrapping up 2024. Everything is above the 4% threshold, and the 10-year bond is now pushed beyond that resistance level it was feeling at 4.5. So now we've broken that. This opens up new territory. Why did this happen? I'm going to give you the data first and then some of the reason why we can maybe make sense of it. First and foremost, tariffs and inflation. We talk about it every episode throughout April and into May now. The conversation is still developing, and there's still so much speculation as to what these tariffs and what the long-term effects are going to be. That being said, we had good news. The Consumer Price Index, which is one of our inflation gauges, we had that report get furnished this past week. That report showed that the headline, this is taking into account the cost of many different things across many different sectors, all of them. The price increases were at 2.3% year over year. That was slightly lower than where the expectations were from economy analysts. That was 2.4. So we saw a little bit of progress, inflation moving closer to 2%, the target. The core, which removes the volatile elements like food and energy, that stayed steady at 2.8%. So when the volatility is removed, hasn't been as much progress on inflation. That remained flat year over year. What's important to note from this report that really stood out to me was the fact that shelter, when I say shelter, that's housing, that's our world, that's what we talk about every week. Shelter component is 1/3 of all of the data. It gets weighted as 1/3 of what we see transmitted to us as a percentage increase. So of the 2.3% year over year increase, 1/3 of those price increases fall in shelter. Shelter came in with around 4% price appreciation year over year. How that gets worked out, very briefly, they take a survey of rents and then what they call owner's equivalent to rent. So if you own a home, what's the equivalent to that? There's a calculation for it, and that's how we get those numbers. Well, looking at those numbers, okay, 1/3 of that is shelter cost. We talk about how inflation has kept interest rates high because the Fed needs to get inflation to go down, and the only way that they can do that right now is to keep their monetary policy restrictive, which is with a high interest rate. Well, if 1/3 of this is shelter, could we be in a scenario where we're chasing our tail? because if the rates don't improve, and there's not enough improvement on prices in the other 2/3 of all goods and services, right? Well, then we're never going to reach 2% because this pricing component for shelter is remaining extremely sticky. Now, I was very interested in this, so I did a quick survey and I used Perplexity to get me a summary and show me what the shelter component of CPI was going back for the past 12 months. And what I can tell you is this: from this point, going back 12 months, there's been slight improvement, 0.1% less price appreciation every month when compared to the year prior. So there's more volatility in the other elements, but the shelter component is showing progress, but it's very slow. But it's there. It's steady. Next, we also have conversations about recession still developing. That means that the Fed's not going to be in any rush to cut, and they said at their meeting, as we mentioned, they are not going to make a preemptive move. They're going to let the market do what it's doing. Then they're going to react. They're going to stay dependent upon the data and make their decisions for monetary policy based upon that. As long as that's the case, we're going to be subject to the headline chaos where one thing gets said or one piece of news hits the wire and then chaos ensues in the market because everyone doesn't know what's going to happen next. All of this is speculation, so they're going to do what they can with the information at hand. But data-dependent Fed is relying on reports that are a couple months old. Really, the data is a couple months old. So there's a lag there, and that proves to be that difficulty when they're looking at everything and if they're staying data-dependent. So that's why the market tries to anticipate and interpret the information in anticipation of what they believe the Fed will wind up do with that information. There's a gridlock that's happening, and I kind of alluded to that before when I was talking about this consumer price index and what those inflation readings look like, but there's a little bit more than just looking at the inflation readings. There's a stalemate right now that the Fed finds themselves in because they have to do something that's almost impossible. And that is to keep inflation as low as possible while also keeping a stable economy and preventing a recession. That's a very difficult thing to do, and that gets more and more difficult as more and more time passes where we exist in a high inflation environment. So what's the end point here? Chaos is going to continue to be the case, and we just need to manage ourselves accordingly. Interest rates have gone up to the highest level that we've seen now year to date, and where we stand looking back for the past 12 weeks, we're on the higher end of those averages. So my point remains home buying. So if you're a real estate professional and if you are a prospective home buyer or home seller, there's no market game to play here. We know what the interest costs are. We know what the interest rate is. If your financial situation can accommodate whatever the situation is that you may be interested in, whether it's purchasing your first home, purchasing your next home, moving up, or downsizing, continue to let your personal financial situation dictate that in your own comfort. Dictate what is going to be best for you. There's not much that we can do by way of prediction at this point, but I believe that in the next few months, we may start to get better footing. And really, it's going to come down to the tariffs. So if you start to see that there's some resolution to tariffs and some more positive progress in those conversations, that's a good time to keep your radar up. Like, okay, now maybe is a good time for me to revisit the situation, take a look, because it's very likely that in that time, we're going to see better interest rates. And then the last thing I'll leave you with as far as the market outlook is concerned, a lot of analysts are expecting at best this year, we'll probably see interest rates reach somewhere around 6.5% by the end of the year. There's going to be a roller coaster ride in between, but that's where most analysts are setting their expectations right now. So if we keep living within this 0.5% margin, it's just a matter of what works for you. That's it for our show today. I hope you found this information helpful and useful. There's a lot going on. So I'm going to make sure I keep my eye on the ball here for you and distill all this down so that you can have reliable, helpful, useful information for your own decision making, whether you're a first-time home buyer or looking to possibly sell and buy, or a real estate professional. I will have another Did You Know episode coming up on our Mortgage Monday. In the meantime, I hope you all have a great weekend and take good care.